Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
All right, guys, welcome back to the show. I am your host, Brett McCullum, and I'm here today with Craig Eppler. Today, we're going to be talking about how Craig grew his portfolio without using his own money. Before we do, guys, at Investor Fuel, we help real estate investors, service providers, and real estate entrepreneurs to 2 to 5x their businesses and allow them to build the businesses they've always wanted and allow them to live the lives they've always dreamed of. Without further ado, Craig, how are you, man?
Doing well, bro. How are you doing?
Man, doing good. Really appreciate you being here with me. And it was super cool catching up with you, getting to know you a little bit. And I'm excited for you to share like a lot of the things that you're doing and are looking forward to. But before we get into all that, let's back up a little bit, give some people some history, some context, and catch us up to speed a little bit. Who is Craig Eppler?
Craig Eppler. Good question. I grew up in the Lehigh Valley, which is about an hour and a half north of the Philadelphia area.
Yeah.
So northeast. Went to school out in York College. So went to college out there, majored in finance. Always loved numbers, but frankly didn't like the theoretical version of numbers, more like the practical side. So I thought finance was a good fit.
Yeah.
So I went through there, had no idea what I really wanted to do in college. I think a lot of people don't, but I interned at 7 different places, right? Everything from insurance to investment management to advisory, all these different things. Got my MBA out there as well, and then moved to Philadelphia to start my career at Vanguard. There, I was on the derivatives trading desk, which sounds a lot sexier than it actually was. But it was cool, fresh out of college. You got to deal with a lot of big numbers because there's a lot of clients, 401k plans that are housed there, and they just deal with a lot of capital. Worked there for a couple years, but wanted to switch over to something that I could feel the client a little bit more. Vanguard's such a big firm that you don't really have access to the clients as much, and you don't really feel the big decisions you're making with all these different zeros at the end of the accounts. So moved over to a firm, an investment advisory firm, also in the Philadelphia area. Started there as an investment analyst and moved my way up through the 7 years I was there to a senior portfolio manager. But that chunk of time is kind of where like my real estate journey actually began. I was living in Center City, Philly at the time, and commuting out to a suburb. And while it's not that far from a mileage perspective, the traffic was horrendous.
Yeah.
So I really got into podcasts. Didn't always do the like a real estate podcast, but found those kind of by jumping around. And I feel like a lot of your like listeners probably got into the like Bigger Pockets podcast. So learned a lot through that, and kind of thought, hey, if these guys can do it, why can't I?
Sure.
So 2017 is kind of where my real estate journey began. Bought my first primary house and did a classic like house hack where I rented the other 2 bedrooms out. Didn't pay for the full mortgage, but I paid for the vast majority of it, which really freed my cash flow up from my job to kind of start buying rentals. From there, 2 years later, I found a credit union that was able to give me 100%
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Home equity line of credit, which I don't even know if they do that anymore.
Yeah.
But I was able to pull on that and buy my next 16 doors with creative financing. After the 16 doors, I found a large portfolio also out in the center of PA. I'm not sure if I mentioned that, but all these portfolios are in Harrisburg, York, Reading area, for those of you who know where that is. And then I bought my big portfolio, which was a 32-unit portfolio in Harrisburg. And I bought that with raising a little bit of money and just using debt on that. So I was able to kind of get into this whole 44-unit portfolio for only about $50,000 to $60,000 of my own personal capital.
Yeah.
So I'll stop there. I guess kind of other things I do as well. I've since left the advisory firm and have started my own fund. The fund is a promissory note fund where we give investors 9 or 10% fixed returns. And I just launched a music royalty fund that closes at the end of April. So depending when this is out, you may or may not be able to get into that. But that's a music royalty fund that gives investors yield at the tune of 7 to 10% plus an IRR of 20%. But yeah, I'll stop there. Brett, I know there's a lot of information.
Dude,
So
no, I love it, man. It's incredible. There's a lot to pull down. It's very interesting because a lot of people, when we're talking about flips or this or that,
Sure.
and you've got a different maybe skill set coming into the real estate game, right? Because a lot of us, that's not how our start was. So let's walk back a little bit. It's college. You're trying to figure out who you want to be when you grow up, right? Yeah.
Still, no, I'm kidding.
Guilty. I mean, I must have had like 102 majors. I don't really know. It just, you don't know. I don't know if you remember. When that was. I mean, you're 21, 22 years old. At this point, I'm guessing. What was the mindset like of I know I want to land here in the finance space? Because there's just not at an earlier age, at a younger age, there's not a lot of mental this sounds smart, to do because that's not it's more rare, I would say. How did that come to be for you?
Yeah, so I mean, I was always good at math. My dad was a CPA.
Okay.
I know I didn't want to be an accountant, but because in my head, they kind of look backwards, right? When you do your taxes, it's what you did in the past year. I thought finance was more of what's in the future, which I thought was more interesting. So that's kind of what came about. I got into kind of trading stocks, did a lot of that stuff early on. So to me, it was kind of fascinating playing with future value calculators. That sounds super nerdy, but playing with that kind of stuff to see, okay, if I have this much money and I compound it by 8 or 10% every year, this is how much money I'll have in 20, 30 years. And just playing with those kind of calculators, I thought was very interesting.
Yeah.
Didn't know, again, what I was going to do in finance. And a lot of people have a picture of what people do in finance. And a lot of that is very different than it actually is. You watch the Wolf of Wall Street and all these different things. That's not what actually happens.
Yeah, right.
Obviously. But I'm not sure if that answers your question or not, but that's
perfect. Yeah, that's interesting because you grew up with, there is a financial background growing up with dad being an accountant. It's in, at least it makes some clarity come to be. And then you're out of college, you start working, and how long, give or take, before you dip the toe in the real estate waters? How long were you in the corporate America type?
So I bought my first primary house just over 2 years after I graduated college.
Okay.
And then my first rental 2 years after that.
Okay. All right. So, and then you were how long in working for corporate America until?
So I house hacked, which I think I try to recommend for everyone. So I did that just after 2 years of being in the kind of corporate America rat race. And then 2 years later, I bought the rental that was outside of my house. So yeah, 2 years and then 2 years later. So really only 4 years.
Okay. So you were,
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
you were working corporately for 4 years, give or take, before you launched the fund. Is that kind of how that?
I'm sorry. No, so the timeline's a little off there. Yeah. So it was 2 years before I bought my first rental, or I'm sorry, before I bought my first primary, and then 4 years before I bought my first rental. I was working in the corporate world for almost 10 years before I launched my fund.
I got you. Okay. Yeah. Cause some of that that's why I was asking, cause a lot of, with a fund, and it's most people, I'll say it like this, get into the fund after they've been in the real estate game for 10 years, let's say.
Right.
And they're like, oh, I could launch a fund. Yours is a little bit more, yes, you had your own personal stuff, different things like that, but it wasn't I'm going to run this professional real estate business for 10 years and then launch.
Correct.
But your background from your corporate job probably gave you a picture of like, there's a way to do something here. Can you talk about that a little bit? I think that's really interesting.
Yeah, so I dealt in funds, because when I was at my old firm at the advisory shop, our job was really, we were a firm of 25 people. We managed about $1.5 billion. So
Wow.
it was my job, along with two of my colleagues, to place, to kind of place like client capital where we best saw fit. Honestly, mostly that was stocks and bonds. But as we got bigger, a lot of our bigger clients wanted exposure to other assets as well, whether it be real estate or private credit.
When was that? What years was that? I have a theory in my head. I'm just trying to work through.
Yeah, so I started there in 2017 and worked there through the end of 2023.
Okay, and sorry, continue. So you were placing different things. Keep going.
Yeah, exactly. Yeah, so we started placing people in different kind of alts when those became more in vogue, honestly, and there were better ways for clients to access them. And as I kind of grew up in that space, I saw that a lot of our clients, frankly, a lot of our clients were kind of mass affluent clients, 60-ish years old, and a net worth of $1 to $10 million was kind of our bread and butter client. So they're well-to-do people. But a lot of them didn't care about the intricacies, in my opinion, of the stock and bond market, and really just wanted a piece of consistent income, which we all know here. If you own enough real estate or a lot of alts, give you a more consistent income stream than stocks or bonds.
Yeah.
So I created the fund based on that knowledge. That's kind of where I came up with the a promissory note fund, which gives a fixed 9% return. And the reason I came up with that number, one, it's fairly competitive for the market, and two, 9% is about what the S&P 500 has done for the last 50 years. So you're getting kind of the stock market return without the volatility, which we've seen a lot here recently.
Sure. Yeah, we can talk about that too.
Yeah.
Especially from the date of this show, I'll let people date it back, but let's just rewind, 3 or 4 days ago when the stock market, everybody's freaking out right now, right?
Yeah. 100%.
If you have a 401k, maybe don't look at it right now.
Yeah, just don't log in. You'll be okay.
Maybe just don't look. No, let me back up. The reason I asked you those dates, earlier, because here's the theory. So being in the real estate game for a long time now, and looking at in the wholesale space, what I've done, a lot of the people in the iBuyer game really started hitting around 18, 19, were you guys, when you were working in that job, is that something you guys were seeing right on that timing too? Or was that kind of in existence before then? What did you guys see?
It was around. Our clients weren't as into the real estate space. We were more allocating, frankly, to the largest guys to buy real estate. We were buying, the 1,000-door multifamily unit, or kind of a building, and in a fund that held a few $1 billion, right? So it was at the very large scale. Our clients at the time didn't really want to be in kind of some of the smaller stuff. So They knew of it, but it wasn't really top of mind in terms of what we were talking about.
Yeah.
if that makes sense.
Because I've always tried to pinpoint that shift. Like when did like everybody know?
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Listening to this, everybody knows BlackRock, Blackstone, you know.
Sure.
You know, there's however many trillions in assets they own right at this point, right? They made a clear shift in an approach to just buy out single family real estate, which was in my head very interesting. And I get it, and I understand why they, you know, but like I wonder why they never did it before and why now all of a sudden they're doing. And it's like, so coming from your background, I was wondering, did you have any insight on that? Like, because it's always a question I've always kind of wondered, like, these are the smartest investment people on the planet, allegedly. And why now, right? Versus before, because real estate has been around since the beginning of time.
Right. I think in my head, and I don't work for those firms obviously anymore. But if I were to guess, and kind of what we're hearing at the time is, you know, Wall Street can get pretty creative with how they invest. And at the time, you know, Class A and B plus multifamily was pretty richly priced. So when they were allocating and kind of adding to their portfolio, they need to get the returns from somewhere.
Right.
And single family real estate obviously has done well. And a lot of those firms, frankly, got burned with those programs, kind of buying everything in sight. But it was another way for them to market another sector that they were in, right? If you had a big fund, right, a multi-billion-dollar fund, you could be in storage, you could be in multifamily, you could be in whatever else. Now you could add single family as another asset class. So it was a way for them to diversify, quote unquote, away from some of the stuff that they had, just something else for them to talk about as well. So I think it was more of a, you know, what are other assets that we can invest in that are still under this great umbrella that we love?
Yeah. It's just funny. And I agree with that, by the way, like the diversification of it all. It just was one of those, like, I never understood why now.
Yeah.
You know, I do think it was probably interesting that rates went to near zero, you know, shortly after that. Like maybe there's something to that.
Potentially.
Again, I'm just speculating, right? But I just was wondering, from somebody that's worked in that industry space for a bit, like some, you know, insights that you may have seen and heard and done, you know, just curious on that. So, just scratching that itch for my questions, honestly.
No problem. Huh?
Yeah. So super, like the background though, that it's just really a, you know, you started buying your own stuff, you worked up to a 44 unit portfolio, and you did it largely on 44 units. What if you, Craig, if you don't want to share it, I'm not going to force you. What is the value of that real estate today?
So if you combine the value of all the real estate, we're looking at $7 to $8 million, depending on what marks are.
Let's call it on the low end. Let's call it the $7 million number.
Yeah. Sure.
And you used how much of your own money?
50 to 70 grand, depending on, you know, where you want to put it. Yeah.
Yeah. That part is what it's impressive, right? That's the cool thing. So how did you get the skill set to, because I mean, it takes a lot of people a long time to figure out like how to leverage properly, right?
Yeah.
Albeit to be able, because you know, you've got the books, you've got the, you know, the Rich Dad Poor Dad, the, you know, Nothing Down with Bob Allen. You've got, there's material out there people can buy and do and stuff. How are you able to kind of come up with that strategy, or had you always considered it? Like, how did that work for you?
Yeah. I mean, I listen to a bunch of podcasts. I like to read as well in terms of like the real estate books. But I listen to a bunch of podcasts, and, you know, there's guys like me and you on here that like actually talk about this stuff. Right. And they were doing this years and years ago. And you kind of heard these stories, and like the tactics weren't all that complex, especially coming from my background in finance. I'd always thought of stuff very black and white in terms of how to structure deals, but real estate really allows you to get super creative in terms of how you put something together. And I thought that was interesting. So my goal after kind of my first rental was, wait, I don't need to come up with 20% every time to buy a house, right? There's a bunch of different ways to do that. I don't need to use my own money. Like people at the time, I mean, when rates were at zero, I was like kind of like I'm raising debt from people at 7%, and they thought it was like the like best thing in the world.
Yeah.
Right. So there's different ways to get into these deals or give people a piece of the like equity pie. To me, from like the learning perspective, just to kind of get back to your question, it was more of just having the interest and having kind of like sparking the curiosity. Like, all right, here's this deal. I think it's interesting. It's something that other people aren't looking at. I think that's another thing that people kind of don't realize is like, oh, it just because it's a deal for me doesn't mean it's not a deal for you.
Right.
To me, a lot of deals are in the actual terms, right? So how you can structure it is really, in my opinion, like 3/4 of it.
Sure.
Obviously, the deal has a pencil. You got to be careful with leverage because it can bite you in the butt. But as long as you protect yourself and kind of make sure that your I's are dotted and your T's are crossed, I think there's a lot of ways to get into real estate with not a lot of money.
Interesting. Yeah, I mean, I agree 100%. It's the learning how to structure deals.
Yeah,
I think that's
the biggest piece.
huge, right? Like, and I'll be honest with you, man, fairly quickly structuring like deals, I love the fact you have that financial background and the acumen to do. Is there any crossover from what you did with like, your previous career into like how you structure real estate deals for yourself? Was there any crossover there?
A little bit. It was mostly in kind of how it was modeled out, right? So I was very comfortable in Excel. So just kind of modeling out like, okay, rents are this is what insurance costs, this is what repairs are. Like modeling that out. I mean, I could crank those out really, really fast.
Sure.
Just like kind of like back to napkin math. Now I don't even need it, right? Like you look at a deal and you can kind of look and be like, this probably works with about this much cash flow, and I can be probably within like 50 or $100 per month kind of thing. So I think that was the biggest crossover. The thing I learned over the course of buying all these units was every seller has a different need.
Yeah.
And some of those needs are quite odd, I think. And just finding stuff, right? I know it sounds crazy, but everything I bought was on the MLS.
Okay.
So finding stuff that's mislisted is really how I found almost all of my deals. Stuff, for example, I bought a 3-unit portfolio of 3 single family houses. It was listed as 1. And it was at a like higher price than everything else in that neighborhood, so no one looked at it and had no pictures. Right, so stuff like that. I had another guy who, and I won't name names obviously, but where I would buy it and he wanted to say that he sold it for X. So I'm like, okay, we can sell it for X as long as it appraises, and I want a seller credit of this, meaning I bring less cash to the table. Right, so we both win. Things like that. I think people don't realize that sometimes the motivations of sellers aren't always like the highest price possible,
Yeah. We typically there's 3 things in any given transaction that people want: speed, convenience, and price.
Yeah.
You can pick 2, you cannot have all 3.
That's good. I like that. Yeah.
We focus on our side of like, how do you structure something that makes sense? You want price, cool, you got to sacrifice some time potentially.
Sure.
You want this, you got to sacrifice this. What's most important? And then there are reasons for it. I think we often like, if we can uncover the motivation, which is not ever, you get somebody that sells a house at a discount, by the way, right? Of any kind. There's a motivation of some kind. And It's our job to really uncover what that is, and then not take advantage of it, but to solve it.
Right.
And I think it's with your ability to structure creatively like that, your ability to do more volume and deal size, it grows. And I think it's just really cool. I love talking to people about creative finance because personally, I don't like it as much as I like some of the other stuff. But you want to know why? It's probably because I'm not as good at it. Right? Like if I was like a wizard, man, I'd be like, dude, creative finance. But intellectually, I go, yeah, that's a super, skill. So cool that you do that, man. And it's really interesting just the way you approach it from that, hey, as a finance guy coming into it, how does this just, like you said, back of napkin math, leads me to a question.
Yeah, shoot.
the people that I know that do deals at the highest levels are not typically putting things out on like, look at this fancy, I don't know, pro forma. Yes, you should pro forma, but like they're not jumping into deals because of a pro forma. They're running it on back of napkin a lot of times, I've found. Do you think that potentially we overcomplicate these, and if it doesn't scratch, because I guess my question is, if it doesn't scratch out on a back of napkin, it probably isn't a deal on a pro forma either.
Right. I 100% agree with that. Yeah.
You're the finance guy, right? So I'm like, all right, tell me, am I oversimplifying that?
No, I mean, I always put the Excel sheet out there just for my own knowledge, and I would, if anyone's getting started in that, like I would definitely say like do a bunch of those, because if you do 50 or 100 of them, like there's not a lot of levers to pull when you're buying a buy and hold, at least, right? It's like, okay, what can you rent it for? What are these different costs? If you do a BRRRR method, like what, there's not a lot of modeling to it. I guess like relative to what I'm used to modeling out.
Right.
So to me, to your point, if it doesn't pencil on the back of the napkin, unless you're buying like a weird complex deal that's like a mixed use thing, and it's a weird, you have to slice the property somehow. But for normal everyday buying a 3-1 townhouse, yeah, if it doesn't pencil, then I don't think it's necessary to go through the whole kind of 5-year projection, because it's probably not going to be right anyway.
I think that's a lot of the investor problem. Is like, well, I have to run it through all the things and spend all the time and do this due diligence and do. I'm like, you just wasted hours of your life that you could have. Does it scratch here? Yes. Okay, now go and do that. Does that make sense?
Yeah.
Yeah.
And just being, again, just not taking no for an answer. If you really want something, unless they really are stuck on one thing. If because if you come to them and be like, hey, can you do a seller financing? They say no. It's like, okay, can you do this? Just giving them multiple options. It's just like an old school sales technique. Like, don't give someone a yes or no question. Give them 3 options, and none of them are no.
Yeah, I like that. No, that's super. That's not wrong. I want you to do me a favor. Like, so on the funds, they're kind of unique, right?
Mm-hmm.
And by the way, if you guys are listening and you're thinking real estate funds and how these are structured, it's unique, guys. So pay attention here. Craig, you were telling me a little bit about it pre-show, and it's very interesting. So tell me like kind of how they work, kind of what maybe the asset classes are, that sort of thing. And like, it's just, and I'll say this, the reason why I want you to bring it up is I know a lot of folks listening, they might be flipping a bunch of houses, doing a lot of things like that. And, you're generating high income, but you're also having to pay taxes out at the highest level too, because it's, short-term capital gains, right? You have to pay it out. So can you explain what you do a little bit more? Go into some detail on it if you don't mind.
Yeah. So I'll start with our core fund. So my firm is called Eppler Capital. It's just my last name and then Capital. Our core fund is called the Promissory Note Fund. And really all we're doing there, it's kind of stupid simple in terms of what yours is. So, say, Brett, you're a client of mine, right? You put $100,000 into our fund. Starting month 1, you get a check. And every month thereafter, you get a check for the next 3 to 7 years. And that's fully customizable to you. So think about it as you're almost buying a bond with my fund. And then the fund is commingled across every client that's in the fund. And we're investing in, again, old school cash cow businesses. So this can be anything from airline parts to an inventory to a franchise to oil and gas to insurance. These are businesses that have been around at least 10 years, have really good margins, have an operator who's been there a while, and are really looking to grow or kind of restructure what they're doing. And to me, the biggest question I get is like, why wouldn't they just go to the bank and not pay and just kind of pay you less? Since 0809 and the kind of real estate crisis there, most banks, frankly, pulled back from lending to most businesses, or if they do, they make it very difficult. I still do my due diligence, and we have first liens on hard assets, but it's a lot easier to deal with us than it is to deal with JP Chase. Sure. Not to call them out, but any major bank, right? So that's kind of where this whole fund kind of actually came from, and honestly, the private credit space as a whole has honestly gotten huge over the last 5 to 10 years here.
Sure.
I'll stop there. And there's a lot of information.
Yeah, no, that's really cool. Yeah, so I like the way you approached it, cash cow businesses. right?
Yeah.
So, a couple questions that of my just hearing that, because this is I think we see it from afar, but don't necessarily recognize what you're doing. The person that, let's say, the businesses that you guys quote unquote lend to, right? What might be some of the, because I'm looking at in my mental brain of like how the crossover is, because they're raising their hand for help too.
100%. Yeah. I mean, my job, frankly, is the intermediary between clients looking for cash flow, right? You're looking for a 9% fixed rate of return, and don't want to deal with, frankly, lending money out to all these individual businesses, but still like the sectors that they're in. So my job is to kind of make sure that those people are taken care of, as well as making sure I'm prudently lending out the money to companies that need it. I mean, ideally they don't need it, right? And they're in a good kind of like a position. But these guys are using it mostly for growth capital, right? So they're looking to expand. They're looking to buy the next location. They're looking to kind of buy more inventory. That kind of thing.
They're not looking for it from a bail me out of this situation.
These are not distressed at all.
Yeah. That's huge. That's kind of what I was looking at is like, man, like, and I didn't think you'd say that, by the way. I was like, I was glad you responded the way I thought you were. But so these are growth minded organizations. They've been around, you said, at least 10 years typically.
Yep.
So very safe from, in theory, they're very safe businesses that you lend to, would you say?
100%. Yeah. And again, everything we have has some sort of hard asset backing it. I learned that from real estate.
Sure.
Right. You always want some sort of hard asset backing it. If you can there are assets that you can do really well without that. But I think in a more conservative fund like this, it made sense for me and my clients to make sure that it was hard asset backed. So for example, there's a group that does e-commerce stuff, right? And we have inventory that we have a first lien against. And another important part of the fund is that there's a coverage on this, right? So we all know that if a product doesn't sell, right, there's a reason it doesn't sell, and that the value of that inventory is probably not what you think it is. For that group, we have a 3 times coverage ratio, meaning if we lent them $100,000, the mark right now is at least at $300,000. So if we did need to sell it, we could sell it at a deep discount.
It's like lending on real estate. It's LTV. Yeah, I think that's
100%.
It's super. Yeah, that makes a lot of sense. Okay, that makes perfect sense. I love that, by the way. Good on you guys. More curious for me selfishly, because I am a musician. I love the royalty fund.
Yeah. So what I heard a lot last year. So I launched this fund in March of 2023. Kind of ran it parallel to my corporate gig, and then launched, and then just kind of went on my own at the beginning of 2024. So the Promissory Note Fund has been around for over 2 years now. But in the first kind of year and a half of business here, a lot of my investors, a lot of my clients thought that the Promissory Note Fund was cool, but they wanted a little bit more juice, for lack of better words, right? They want a little more upside. So I'm like, okay, we can give equity upside to things. And I come across a lot of different deals. I mean, my job is to go through deals all day, right? So I'm looking at 3 to 10 deals a week, depending on what comes in.
Yeah.
So I get a lot of deal flow, and I met these guys last year. Really like what they were doing with the a music royalty space, and I thought it was a unique way to attack this. So I'll give kind of like the quick, kind of like the quick story here. I know it's not real estate focused, but I think there's a lot of similarities, honestly.
Of course, yeah.
So I'm not sure if you guys have heard. If a few years ago, Justin Bieber, obviously popular, a pop singer, sold his music royalties to Sony Ventures to the tune of $200 million.
Yes, a lot of money.
Right. Now, what this group is doing is they're not going after the Justin Biebers of the world, but they're going after the people who work for him. So his songwriters, his producers, his managers, people like that, who still get compensated partially through music royalties.
Yeah.
So these guys are getting checks every single month or every single year from the amount of times that his songs are played on Spotify and iTunes and TV commercials and TikTok, all this other stuff, right? So what these guys are doing is they're going around and kind of finding those smaller guys, for lack of better words, and gathering them up into a larger portfolio. So they're raising $150 million to buy up these smaller guys, and they're paying only 5 to kind of 10 times multiple on their money. Once they bring all that together and kind of put it in one nice, pretty package, they'll sell it to a big private equity company like a Blackstone or a KKR or even a Sony Ventures. And because that group doesn't have to do the work to kind of go around and find these smaller guys, for lack of better words, they're willing to pay a multiple of 15 to 20 times. So from an investor perspective, I honestly like it a lot because it's an asset that cash flows, right? Every time me or you are on Spotify and listen to Justin Bieber or whatever, like your like music of choices, they get paid a fractional penny of that. And if you kind of multiply that over this big portfolio, it becomes a 7 to 10% yield, which isn't the worst thing in the world. So you're getting paid to own it. And then at the end of it, you're getting the multiple, right? So you're buying these things for 5 to 10 times and selling them for 15 to 20 times. You're getting that expansion as well. So on a $100,000 investment, you're getting like $10,000 a year in yield. And then at the end of the term, you're going to get a check for $200,000 to $300,000 as your like a multiple. So it gives you a blended IRR, if you kind of blend it all together, of 20-ish%, which is obviously much more attractive than like the 9% fixed return. Obviously, it's a lot safer in that one, but it's just a different investment. So
dude, super cool. And I love the way that your mind works at looking at different opportunities. Because I think most of us get, like, it's not to say that this is a real estate show. So it's nice to not say, and we know that real estate is great. It's a hard asset. You can predict it. You have it yourself. It's part of your, but I like the fact that you're looking outside of simply just real estate and not being stuck there. And then, but applying the principles maybe from real estate in some of the ways into those other things. I think it's unique, man. I'm so glad to have met you and talked to you. It just expands our horizon of what's possible.
Likewise, appreciate that.
Yeah. To that point, how can people connect with you, get to know you a little bit further?
Yeah. So if you're interested in the fund investments at all, you can find us at epplercapital.com. It's my last name, EPPLER.com. I'm sorry, epplercapital.com. We're on LinkedIn. We're on Facebook. If you want to shoot me an email, you can shoot it to the info one. So it's info@epplercapital.com. That's where all the information is. But yeah, we're pretty active there. We're posting probably 3 to 5 times a week, as you can see our content there.
Amazing, dude. This has been super cool. I've definitely made me, my mind's just racing, like I'm thinking a lot. And
I love it.
Yeah, good for you. I love that. Yeah, man. So, seriously, thanks for coming on the show with me today. I appreciate you being here.
Yeah, thank you, Brett. I appreciate it.
Yeah, and guys, seriously, connect with Craig. Look into that. I mean, it's really unique. I love it, man. So cool. Well, guys, I appreciate you being here and hanging out with us today. We'll see you guys on the next episode. Take care, everybody.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.